The bigger buy now pay later, as they market themselves, HUMM says that they are always interest free, which is true. However, they are not always cost free, and today we're going to be talking about some stuff you should know if you are looking to get a HUMM loan, and some stuff you should also keep in mind as well. Now, a few months ago we talked about the new interest-free credit cards from CBA and NAB, the CommBank Neo and the NAB straight up card. And we talked about how these cards are obviously interest-free, however they are not always cost-free, and we also talked about some examples as to how they compare with normal credit cards, so you might want to check out that video as well somewhere here. So of course we have to cover HUMM as well, because HUMM also falls into this new realm of interest-free finance. Now guys, if you're new here, my name is Fyzee. This channel is about finance and investing. Before we begin, this video is not financial advice. I'm not a financial advisor. I'm not telling you to go get a HUMM loan. This is just for entertainment and informational purposes. Let's jump into it. Now let's actually have a look at HUMM's offering. Now, as you can see, their main selling point is that they are the bigger buy now pay later, and they offer big ticket items up to $30,000, which is pretty insane, and that too with interest-free offerings. I think Afterpay's maximum amount is only a couple of $1,000s, so compared to Afterpay, HUMM is giving customers what other buy now pay laters aren't necessarily doing. So looking at the website, you can definitely see why people would want to go with HUMM in the first place. You can finance things like solar panels, which are traditionally pretty expensive, and these things are quite desirable as well, because obviously they're going to save you electricity and they're going to pay themselves over time. You can also finance tech items, clothing, and other stuff as well. Now looking at this one, this was pretty interesting. So you can actually finance your bills as well using BPAY, and when you scroll down, you can even see that you can even finance phone and internet, gas, electricity, water, even school fees, household expenses like rent, bond, strata, and rego, and insurance. So it is quite widespread in terms of what you can finance. So let's have a look at this in much more detail. So as we can see, if the bill is over $80, you'll get charged an $8 monthly fee, which, to be honest, pretty much every bill these days is going to be $80. So you're going to be paying that $8 monthly fee regardless. So let's do some quick calculations about this. So let's say that realistically the bill is $500, and if we use what they say, which is 5 months worth of repayments, we will be paying $100 per month, and that'll be roughly around $50 per fortnight, right? So if you start to pay the $8 monthly fee, you're going to pay around $40 overall in terms of fees. That's pretty much $8 worth of fees for 5 months. And then of course, you'll be paying the $500 for the actual bill. So if we actually calculate the fees as a percentage of the overall cost that you pay for the actual bill, if we kind of divide the two figures, if we do 40 divided by 500, you're paying roughly around 8%, which is pretty insane. And if you do a quick comparison of 8% versus today's mortgage rates, you're paying almost quadruple the mortgage rates at the moment, because the cheapest rates are sub 2%, and you're paying so much just to access that $500 worth of credit. So what I mean by cost of credit is the cost to actually obtain the credit, which is the $500 to pay the bill. That cost is $40. So you're paying $40 to access $500 to pay the bill, and then you're also paying the $40 to HUMM as a thank you for offering you that credit, if that makes sense. Now, if you compare it to other methods like a credit card, it definitely is affordable in that respect. I don't know any credit cards at the moment that are 8% or close to it, so it is cheaper than a credit card. However, paying 8% just to finance a bill, in my opinion, it is not really that cost effective. It is still fairly expensive. But look, as I said at the start, this is not to kind of convince you to use HUMM or not use HUMM. This is pretty much the pros and cons, and of course, you can be empowered to make your own decision. Now, I also want to say, with these new buy now pay later offerings, they often like to advertise the monthly fee instead of saying the interest rate. And the reason why, one of the reasons why, is because the fee is quite small in terms of dollar terms, right? If you just have a look at it from the outside, paying $8 to access credit, paying those $8 to kind of pay those bills and have stress-free living for the time being is pretty convenient. And as a person, you might not really think too much of the $8 because your daily spending might be much more than $8. So you might just look at it as a very tiny, a very small cost. But then if you actually do the maths behind the $8 and kind of compare the $8 to what you're actually spending on, I think that is worth looking at. If these guys just advertised 8% interest rate on their website to actually access the credit, pretty much nobody would use them because that seems pretty ridiculous. But all of a sudden, if you change the 8% to an $8 monthly fee, all of a sudden it's actually pretty digestible. It seems like a pretty good deal. And basically by doing this, all they're doing is that they're just playing on people's psychology. It is not illegal. It is pretty much just sales. They're a business, they have to make money, and as consumers we have to be mindful of this. And the thing with interest free is that pretty much everyone in the Western world, or pretty much anyone around the world, we are pretty much conditioned and we're used to believing that if something is interest free, by default it has to be a good deal. We become pretty curious about the fact that it's interest free, and we have our own biases when it comes to this sort of stuff, and we kind of think that if something is interest free, it has to be a good deal. There's just no way that it could be a bad deal. It's worth looking into. Now let's jump into their overall pricing strategy and see how different examples and different loan amounts can affect you financially. But before we do, if you guys have found any sort of value so far, please leave a like or subscribe. It does help out. Let's jump into it. So as we can see right here, if you're trying to finance little things, which is pretty much any sort of bills or items below $2,000, and if you're paying it within 5 fortnights, it's pretty much going to be cost-free for you. As you can see, no monthly fees, no establishment fee, and no repeat purchase fee as well. So it's actually not too bad for that respect. And 5 fortnights is roughly 2.5 months. But if you switch that to 5 months, which is 10 fortnights, as you can see, monthly fee is going to be $8 and late payment fee is $6 throughout. And that's the example that we talked about with the BPAY earlier on. The BPAY example that we spoke about was paid over 5 months, so that's why the $8 monthly fee was charged. If you pay that same bill over 5 fortnights, then I believe the fee would not have been charged to you. And then of course, lastly, we jump into the big things, which is pretty much anything under $30,000, and the repayment period is between 6 to 60 months, so half a year to 5 years. And the monthly fee is $8, and then comes the establishment fee and the repeat purchase fee as well to get you guys to kind of use the service more and more. Now, one thing that I think may be a bit unethical, and look, this may be just me being really nitpicky and kind of looking more deep into it, is when you kind of look at this from the outside, the way that they say 5x fortnightly, you might think that obviously we can see that there is no fee for that category. However, if we're trying to pay it over, let's say, 6 fortnights, one would actually look at this graph and think, if we're paying for 6 fortnights, surely it shouldn't cost us the monthly fee. However, if you scroll down to the fine print below, you can pretty much see that anything over 5 months or greater, you will be charged the $8 monthly fee. So pretty much, if you finance something over 6 fortnights, you'll be paying the monthly fee, which I think they could have explained a bit better just in this graph. I think if they just added in a less than sign, like less than 5 fortnights and less than 10 fortnights, if they added in something like that, I think it would have been so much easier. So yeah, I think that might be slightly misleading. I don't know, let me know what you guys think. Maybe this is just me being a bit too kind of nitpicky and a bit too deep into it, but yeah, let me know. So let's look at some more examples for purchasing. So let's say that you buy something worth $2,500, and that counts as a big thing. And let's say that you have 12 months to pay it off. Your repayments will be $208 per month. Now, of course, you'll be paying a monthly fee of $8, and let's say that the establishment fee will be $35, let's just call it. Now, the total fees that you'll be paying will be $131, and the fees as a percentage of your overall cost is 131 divided by 2,500, and the fee is 5.24%, which I guess it isn't too bad. It is kind of cheaper than a personal loan. It's cheaper than most personal loans, but still it's not the cheapest thing that you could do because it is still more expensive than a mortgage. But let's say that you spread that $2,500 for 3 years, then the cost is actually 4.3% per year, mainly because the establishment fee is divided into 3 years, so it might seem like a good deal. However, do keep in mind that just because the yearly cost is low, you are still paying the yearly cost 3 times in a row. You're paying 4.3% per year. So it is cheaper per year than the first example, but you do end up paying more because the loan term is longer, if that makes sense. In the first example, the cost is 5% for the 1 year. Second example, the cost is 4.3%, but for 3 years. So although the cost of credit is actually cheaper, overall in terms of dollar terms, you will end up paying more. Now let's talk about some big purchases, and this is where things get pretty interesting. So let's say that you buy something worth $15,000 over 5 years, which is 60 months. And let's assume the establishment fee is somewhere in the middle at $60. Then the overall cost is $8 monthly fee times by 60 months, which is $480, plus $60 worth of fees, and the total cost is $540 for the 5 years. Then the fees as a percentage of the overall cost is $540 divided by $15,000, and that is 3.6% cost over the 5 years. So if we divide that 3.6% by 5 to get the annual figure, the yearly cost is going to be 0.72% per year, which is very cheap comparatively. Now, if you were to compare this to getting a normal mortgage, and if you took out a $15,000 loan with, I don't know, CBA, it's going to cost you more because mortgage rates are nowhere near 1% or less than 1%. In fact, I've got the CBA calculator in front of me right now, and we can see that $15,000 over 5 years, principal and interest at 2.59%. The fees are going to be, or I should say the interest is going to be $1,000 over those 5 years of repayment. So you are getting a fairly good deal when compared with a normal home loan if you go with HUMM. So as you can see so far with HUMM, the more money that you borrow, the less the cost is going to be to actually access that credit, if that makes sense, because we're talking less than 1% for a purchase like $15,000. And that is mainly because the monthly fee remains constant and only the establishment fee changes based on loan amount, I'm assuming. And from these findings, we can also see that the lesser you borrow, the more you're going to pay as a percentage of your credit. So if you're financing those little things like those $500 bills, those $2,000 bills, it's going to cost you a lot more to actually access that credit than if you are trying to borrow a bigger amount for, say, tens of thousands of dollars, if that makes sense. Now let's do one last example of $30,000 financed over 5 years, and similarly the establishment fee is, let's say, $90 at the higher end, and the fees are going to be $480 in terms of monthly fees. These fees pretty much stay constant. Then the overall fee that you'll end up paying is $570. Then the overall cost is 1.9% over those 5 years. And if we divide the 1.9% over 5, the cost per year is 0.38% per year, which is very, very cheap. Now, a few things to note with these examples: we haven't really factored in the repeat purchase fee of $22 or the late payment fee of $6. I'm assuming you guys are going to be paying everything on time and you're not going to be paying that $6 fee, I hope. But if you do these things, obviously it's going to push the cost up. And the thing with these products is that they make it very easy for you to sign up. They make it very easy for you to kind of get reeled in and get hooked into these products. And look, you might be someone who's super disciplined. You might say to yourself that I'm only going to use HUMM once. It's just going to be an exception. It's a one-off event. And then you use HUMM and then you actually realize how easy it is to use. They make it super simple to track your repayments and everything. It's very easy to actually pay back the loan. And then as you go on with your life and your day-to-day spending, you will always have at the back of your mind that if something goes wrong, I can always rely on HUMM. And that's how they kind of reel you in. They make it so easy for you to use it for the first time. And then once you kind of get used to it, then they start charging you those repeat fees and those monthly fees and so on and so on. So as a consumer, you really want to make sure that you take these into account. Now, based on what we've discovered, I also think that these sorts of products affect people disproportionately, in a sense that if you're someone who has a pretty high income, chances are you're not going to be financing your day-to-day bills. You're mostly going to be financing big products like solar panels or TVs and stuff like that. So your actual cost to access that credit is actually going to be pretty little. You might only be paying 1 or 2% to actually access the credit because you're paying for those big amounts. However, someone on a lower income is probably not going to be financing big purchases like that. They're probably going to be trying to finance, those small items, those day-to-day bills, rent and stuff like that. So based on the examples that we've had a look at, they're actually going to end up paying more because the cost to actually access that credit is so much more for smaller amounts. And with stuff like this, it is pretty unfortunate because this is where people can fall into the debt trap where they're trying to rely on buy now, pay later services for day-to-day stuff. And that is where things can get pretty tricky. And the other thing with buy now, pay later, and the reason why they are so successful around Australia and pretty much everywhere they operate, is the fact that they make it so easy and the actual repayments are so tiny that you barely even feel it. And that's why you actually end up spending more, because the repayments are so small, and psychologically you just keep doing it because it just seems so tiny. Now, one thing to also note is that with these sorts of services, they actually lower your borrowing power as well. If you're trying to go for a loan or if you're trying to refinance, you do have to keep that into account. If you've got a fairly decent income, then it might not matter too much, but if you're trying to pretty much borrow at the maximum to get as much loan as you can, you do want to watch out for stuff like this. And in case if you're trying to increase your borrowing power, I've done a full video on that already. You can check it out right here. This video goes into some tips and tricks you can use to increase your borrowing power as well. Go check it out. I previously used to work as a mortgage broker, so this is pretty much from my experience. It should be pretty helpful. Now look, I just want to make it super clear once again. I'm not telling you to use HUMM. I'm also not telling you to not use HUMM. This is just a video about pros and cons and some facts that you need to consider if you're looking to consider options like this. Now, interest-free credit cards are also becoming pretty popular these days, and if you want to check it out, there should be a video right here. This video compares interest-free credit cards like Combank Neo, NAB Straight Up Card, and the Harvey Norman interest-free cards as well. These 3 interest-free cards are pretty popular in Australia. Go check it out. And guys, thank you so much for watching. Please like and subscribe, and I'll see you in the next one. Bye now. I'm not saying to